You have decided to buy a term insurance plan? Good. That's honestly one of the most important financial decisions you'll make. But then you go online and suddenly there are 40 plans, 15 comparison websites, premium calculators that give different numbers, and every ad telling you this is the best. You end up either buying whatever sounds like the cheapest option or putting it off for 6 months because it feels too complicated. Here's the truth. Choosing the right term plan is not complicated if you know the 8 decisions you actually need to make in the right order. I'll take you through a step-by-step framework for choosing a term plan that fits your life. Not a generic recommendation, not a sales pitch, not a comparison of premiums, the actual decisions and how to make them. Most people start by comparing premiums. That's actually the wrong place to start. Think about why you're buying a term insurance. It's not for you. You're buying it so that when your family makes a claim, the money actually reaches them without a fight. So the first decision is not which plan, it's which insurer. There's one number that tells you almost everything you need to know about an insurer's trustworthiness: the claim settlement ratio, or CSR. This is the percentage of claims the insurer has paid out versus the total claims received in a year. A CSR of 98% means that out of 100 claims filed, the insurer paid 98. A CSR of 90% means 10 families out of every 100 didn't get what they were promised. The IRDAI, India's insurance regulator, publishes CSR data for every life insurer every year. For financial year 2025-26, ABSLI's claim settlement ratio stands at 98.86%. That places it among the leading ratios in the industry for the specified period as per IRDAI annual report. Looking for a CSR above 95%. Anything below that is a risk you're passing on to your family, not yourself. 2 other quick check. How long has the insurer been operating? Longevity indicates financial stability. Aditya Birla Sun Life Insurance has been India's trusted partner in protection for 25 years, securing over 1.5 million families. The second decision is how much cover to buy. And I'm going to keep this segment intentionally brief because we have an entire dedicated video on this channel that walks through this in full detail, including a live calculator walkthrough and a dime formula breakdown for 5 different life stages. Link is in the description. But the core principle here is this. The right cover amount is not rupees 1 crore because it sounds safe. It's the gap between what you would leave behind for your family and what they actually need. 2 sides to that equation. On one side, what you owe. Your loans, your future income that your family depends on, your children's education costs. On the other side, what you own. Your savings, investments, existing insurance. The gap between those two is your cover requirement. Then add 20 to 25% for inflation because your money should not lose value over time. Quick rule of thumb. If you haven't done the full calculation yet, don't buy less than 15 to 20 times your annual income. At current inflation rate, a 10x cover may not be sufficient for those with significant dependents and liabilities. Here's where most people just pick whatever comes up first on a comparison site. But term plans come in meaningfully different variants. And the right one for you depends on your situation. Level cover. For the first time starters, the most common type variant is level cover. Your sum assured stays fixed throughout the policy term. If you buy rupees 1.5 crore cover today, your family gets rupees 1.5 crore irrespective of when your family claims during the policy tenure. This is the best option for most people. Simple, predictable, easy to understand. If you're buying your first term plan and not sure which type to choose, start here. Increasing cover for the inflation conscious. Increasing cover grows your sum assured over time, typically at 5% per year, up to a maximum cap. So if you start with rupees 1 crore, it becomes 1.05 crore in year 2, rupees 1.10 crore in year 3, and so on. This is the best if you are a young earner in their 20s or early 30s, expecting your income and responsibilities to grow over time. The cover keeps pace with your life rather than shrinking in real value due to inflation. Here's the trade-off. The premium is higher than a level cover plan for the same starting sum assured. But if you think about the inflation-adjusted value of your cover 15 years from now, Increasing cover often makes more financial sense. Decreasing cover. For loan protection. With decreasing cover, the sum assured reduces over time, typically designed to mirror a declining loan balance. If you have a home loan and that's the primary thing you want covered, a decreasing cover plan tracks your outstanding principal. It's best for if your primary insurance need is loan protection and if you have other financial assets to cover your family's income needs. Not a good standalone plan for someone with dependents and no other wealth. Return of premium, TROP, for value-conscious buyers. Now, with a standard term plan, if you outlive the policy, you get nothing back. And that's the design. You were paying for protection and you didn't have to use it. But if the idea of paying premiums for 30 years and getting nothing back bothers you, there is a TROP option, term return of premium. If you survive the policy term, you get all your premiums back excluding GST. The honest trade-off, TROP premiums are significantly higher, sometimes 2 to 3 times of the cost of a standard term plan. For most people, that calculation favors the standard term plan. But if the psychological reassurance of getting money back matters to you, TROP exists for exactly that reason. Joint life for dual income households. If you and your partner both earn, joint life option is for you. A joint life term plan covers both you and your spouse under a single policy. If either of you passes away during the policy term, the surviving partner receives the full sum assured. The policy then typically continues to cover the surviving partner independently. So, they remain protected without needing to buy a new plan. Now, the question most couples ask is, should we get a joint policy or 2 separate individual policies? So, 2 separate policies usually give you more flexibility and often comparable total cost. With 2 individual policies, each partner's cover amount can be sized independently to their own income and dependence. If one partner leaves a job, becomes a homemaker, or has a change in health, the other's policy is completely unaffected. Joint life option makes sense if you and your partner want one policy, one premium payment, one renewal to track. It's also useful when one partner might struggle to qualify for standalone cover due to health reasons, since the joint policy underwriting considers both together. However, do understand exactly what happens after the first claim. Does the cover for the surviving partner continue automatically at the original sum assured? Or does it reduce? Or does the policy terminate entirely after the first payout? Always check before you sign. Bottom line is that dual income households need dual protection. Whether that's a joint policy or 2 independent ones is a fine-tuning decision. But both partners being uninsured or underinsured is the scenario you're trying to avoid. Here's a snapshot of all the variants for you to explore if you may want to take a quick screenshot for revisiting later. Now, how long should the policy run? And this is where a lot of people underbuy without realizing it. The instinct is to align the policy term with your retirement age, say 60. But think about what happens after 60. Do your dependents disappear? Does your home loan magically clear? Does your spouse suddenly become financially independent? For most people, the right approach is to cover yourself until the point where your financial obligations are largely fulfilled, which in most cases is 65 to 70, not 60. There's another reason to go longer. If you develop a health condition at 55 and your policy is about to expire, you may not be able to buy a new one at an affordable premium, or at all. The longer policy term locks in your current health profile at today's premium. A practical guide. Take the age at which your youngest dependent will be financially independent, typically around 25. Subtract your current age, add a buffer of 5 years, that's your minimum recommended policy term. And if that takes you past 65, round up to 70. Trust me, the premium difference between a 30-year-old and a 40-year-old policy is usually smaller than most people expect, especially when you buy young. Option 1 is regular pay. You pay premiums for the entire duration of the policy. A 30-year policy means 30 years of payments. With option 2, limited pay. You pay for a shorter period, but the cover lasts the full term. For example, pay for 10 years, covered for 30. This costs more per year. but you finish your payment obligation earlier, which is useful if you're self-employed, expect income to fluctuate, or want to be premium free by the time you retire. Option 3 is single pay, with which you pay the entire premium upfront in one go. The policy then runs for its full term with no further payments. This works well if you have a lump sum available, say from a bonus or inheritance, and don't want any future liability. Here's the catch. Limited pay and single pay carry higher total premium outflow in absolute terms for some configurations. But then, they also eliminate the risk of a policy lapsing during a financially difficult year. That's the real value. Certainty. Now, annual payment is the most cost efficient. Did you know that often a small charge is loaded for more frequent payment modes? If annual premiums feel like a large single outflow, half-yearly or quarterly options spread out the cost. Monthly is available too, particularly convenient for salaried individuals since it can be auto-debited on a salary day. One non-negotiable regardless of frequency: set up an auto-debit or standing instruction on your bank account. A policy lapse due to a missed premium payment is one of the most avoidable and costly mistakes in personal finance. The cover disappears, and when you try to reinstate it, you may need fresh medical underwriting at an older age. Riders. And this is where term insurance becomes genuinely customizable rather than one size fits all. A rider is an add-on benefit you attach to your base policy at a modest additional premium. Each one covers a specific risk that the base term plan doesn't. Let me walk you through some available riders you may consider based on your needs. Critical illness rider. For those looking to secure their family's lifestyle against medical emergencies. This pays out a lump sum if you're diagnosed with a listed critical illness: cancer, cardiac event, stroke, kidney failure, and others. The payout happens on diagnosis, not on death. Here's why this matters. A serious illness doesn't just cost you medical bills. It often means months or years of career break. Your family needs income continuously while you recover. And the base term plan, which offers death claim, doesn't help with that. This rider is especially important for self-employed individuals and primary earners. Accidental death benefit rider. Who it's for? Young earners, regular commuters. If death is caused by an accident, this rider pays an additional sum assured on top of the base policy payout. So, if you have rupees 1.5 crore base policy and a 50 lakh ADB rider, your family gets rupees 2 crore in case of accidental death. The premium for this rider is very low related to the additional coverage. Worth considering for anyone with a long daily commute or physically demanding profession. Waiver of premium on critical illness or disability. This one's for everyone. If you're diagnosed with a critical illness or, God forbid, become permanently disabled and can't pay premiums, this rider waives all future premium payments. Your cover continues in full for the rest of the policy term at no further cost. This is arguably the most underrated rider in the market. At a very small additional premium, it ensures that the scenario most likely to disrupt your premium payments, serious illness, is exactly the scenario where your premiums get waived. It's a circuit breaker for lapse risk. Hospital cash and surgical care riders. Who is it for? Those without comprehensive health insurance. These provide daily hospital cash benefits and surgical expense coverage. Important if your health insurance cover is thin or doesn't include critical illness. Rule of thumb: don't buy every rider. Buy the ones that cover your specific risk gaps. The final decision is one that most people never think about at all. When your family makes a claim, how do they receive the money? This matters more than it sounds. There are real documented cases of insurance claim amounts being mismanaged. Poor investments, family disputes, rushed financial decisions made in grief. You can protect against this. Lump sum payout. The full claim amount paid in one go. Best when your nominee is financially capable, has investment knowledge, and when there are large one-time liabilities to settle, like a home loan or business debt. Monthly income payout. The claim amount is distributed in fixed monthly installments over a defined period. Best when your nominee's primary need is income for regular household expenses, children's school fees, monthly EMIs. Takes the pressure off from making a large financial decision during an emotionally difficult time. Lump sum plus monthly income A portion of the claim is paid immediately to handle urgent needs, debt clearance, emergency expenses. The remainder is paid out monthly. This is the most versatile option for households where both immediate and ongoing needs exist. One additional layer of protection worth knowing. If you are married male, you can purchase your term plan under a Married Women's Property Act, the MWP Act. This legally ensures that the claim amount goes directly to your wife and children and cannot be claimed by creditors or other legal heirs before them. It requires a simple addendum at the time of purchase and costs nothing extra. If you're married and haven't looked into this, you should. Your 8-point term plan decision checklist is summed up in a short table. Save this frame for easy relook.
Before we close, here are some FAQs that come up every time we cover this topic. So how do I choose the right life insurance plan in India? Where do I even start? Start with the insurer, not the plan. Check the claim settlement ratio published by IRDAI. Look for anything above 97% consistently over 3 years. Once you have a short list of trustworthy insurers, then compare cover amount, policy term, rider options, and premium. Most people do this in reverse and end up with the wrong plan. How do I buy term insurance online in India? And is it safe? Yes, buying term insurance online in India is completely safe and is regulated by IRDAI. Go directly to the insurer's website rather or an aggregator. Fill in your details accurately, complete the medical declaration honestly, and make the payment online. The policy document is issued digitally and is legally valid.
If this video helped you think more clearly about one of the most important decisions you'll make for your family, hit like. It takes 1 second and it helps people who are stuck on this question to find the video. And subscribe if you want to keep watching content like this. Practical, numbers driven, no jargon, no scaremongering, just the framework you actually need.